Hello. Today we're going to be discussing Velocity Banking 101. Our first lesson is going to deal with the transfer of debt. Okay? So before we hop into the lesson, we must give you a background. There was a man who was a really, really good car maker. I mean, he knew how to make cars. However, he failed 2 times. I mean, went bankrupt 2 times. And so he said, you know what, maybe this car business isn't for me. I know I'm a good car maker, but maybe it's just not in the cards. So he went to a carnival, right? He went to a carnival and saw some butchers butchering meat, right? Way back in the early 1900s. And as he saw these men, these butcher brothers, chopping up this meat, he saw that one of them was getting the meat ready, another one was chopping the meat, and then another one was actually selling the meat. And right then and there, he got the idea of, hey, what if I could do that with my car business? Can you guess this man's name? His name was Henry Ford. And the reason I brought that out is because when it comes to finances, when it comes to your lines of credit, when it comes to your loans that you have, we need a system, but not just any system. We need a system that works. And that's what we've come to discuss today. Okay? So us as Americans, the national average is $5,000 a household. That's the husband makes $2,500 a month and the wife makes $2,500 a month. So that's $5,000. Where do we normally put that money? That's right, inside of the checking account. And some of us even have savings accounts, right? So we put the $5,000 inside of our bank account, which later on I will be discussing why it's actually called the black hole account. Okay, so this $5,000, when you're living on a cash basis, you'll be putting your money inside of the bank. That's what enables you to live on a cash basis. And that's not really what we want. Because when you live on a cash basis, you've got a mortgage. Let's just say it's $1,200, okay? And that mortgage is $1,200, but you can't spend that $1,200 because why? You are going to not have enough money, okay? And we gotta pay the mortgage, right? So that's why I say it's not really a good idea to live on that cash basis. Well, let's divide out some more of this $5,000. We already have the $1,200 there for the mortgage. We got another $600 here because we have a couple cars, right? So that's $600 a month. Right down here is another $600 a month. What's that one in? The national average for credit card debt, all right? $600 a month is what people shell out, and that is the minimum payment, right? $600 a month, and then we have another $1,200 a month for expenses like gas, dining, groceries, okay, things of that nature. And in the savings column here, we have $1,400. So now we have the $5,000 split up into 5 pieces. When you do this, your cash flow is 0, okay? And what we want to do right now is make sure that we add cash flow, okay? That's what we want to do. We want to add cash flow to our portfolio. And you're saying, well, how do I do that? How do I add cash flow to this portfolio? And I'll show you how. It's going to be through the line of credit, okay? Before I show you that, I want to show you the difference between simple interest and amortized interest, okay? And this is what I mean. Over here on this side is your line. What do I mean by line? I mean your line of credit, okay? That's simple interest. Not only is it simple interest, but it's also revolving. This means you can take your line of credit, you can pay the gas, you can pay your water bill with it, you can pay your rent with it, okay? And you can pay it back, okay, through your monthly income, and you can use it again and again and again. So it's pay, borrow, pay, borrow, pay, borrow. You can do that when it's simple interest on your line of credit, okay? Now, on your loan, you better not think about it, right? Okay, on your loan, it's going to be something totally different than your line. When you pay your loan, that money's gone. 100% of that money has disappeared, okay? So we have loans, right? We have the $1,200 mortgage, we have the $600 a month for our couple cars, don't we? So let's say that mortgage is $200,000 at 6% interest, and we're paying the $1,200 a month. But we're not done. We still have the cars. $600 a month for the cars. And let's just say the price on those are, let's say that one's $15,000, right? You say, that's pretty cheap. I know. And let's just say that's another 6% as well. Amortized debt. So here we are with a loan. But let's be realistic. We like credit cards too, right? And I'm going to show you how to use them. Let's go ahead and type up a scenario for the credit card. You have $15,000 as a limit on your line of credit and $12,000 as your balance, okay? And that's going to be at 21% interest, and you're paying the minimum $600 a month. Remember? That's what we had right here. That's the $600 a month. So look at all this that we have. Look at all of our bills. How are we going to transform our cash flow into a positive cash flow when we have all of these bills to pay? I'm glad you asked that question because this is how we're going to do it. When you look at examples like this, what's the first thing that comes to mind? That you need another job? That you need a second job? That you need a third job? Well, watch what I do here, and maybe we can submit to you a reconsideration, okay? $5,000, instead of putting it inside of your checking and savings account, okay, why not put that same $5,000 inside of your line of credit? Ooh, I know that's pretty scary. You're asking, wait a minute, why are you saying all of the $5,000 inside of my line of credit? That doesn't make sense to me. I'm going bonkers. I think I'm going to turn you off now. Let me show you why you should reconsider where your money goes, okay? Because when you place this $5,000 inside of the bank account, remember what you're living by. You're living piece by piece. You're living on a cash basis. And you're thinking you're saving, but let me show you what's really happening, okay? I want to pull the blinders back on the banks. Say you saved up $10,000 inside of the bank, right? But as life goes on, okay, months have gone by, the kids have grown up, okay, and you need a minivan that costs, guess how much? $10,000, right? Now you saved up $10,000, congratulations. Why won't you use that $10,000? Because you need that $10,000 for a rainy day, right? You need it for an emergency fund. That's what we've got taught, right? Well, this is what you'll do. You'll go to the same bank that has your $10,000 and say, Mr. Banker, I need a loan for $10,000. And the bank will say, well, let me check your credit history. Okay? And they'll look down, they'll say, okay, can we trust him to pay it back? Yeah, and he also has $10,000 in the bank. Okay, yeah, so this is what we'll do. We'll go ahead and lend him his $10,000, and we'll go ahead and say, hey, that'll be 6% interest as you pay it back to us, please, and thank you. So we'll congratulate him that his credit score was good, and we'll also lend him his $10,000. I know you think that's unbelievable, but that is so believable because it's really happening. Absolutely. That's what happens. They take your $10,000, give it to you, and say, hey, that'll be 6% interest, please. So let's utilize the banks and the tools that they have to put more money in our pockets. That's all I'm saying. All right? So that's why we no longer want to think like we used to think, the way that doesn't work. We want to utilize a way that does work, that keeps our money going, that keeps our cash flowing. Okay, that's what we want to do. So now the $1,400, all right, we're going to get to that in a little bit. I know you're still shocked that we're putting that $5,000 inside of our line of credit. But when we do that, I want to show you on a chart why we want to do that $5,000 inside of our line of credit, okay? First and foremost, when we put the $5,000 inside of our line of credit, will we have to worry about paying that $600 a month? No. All right. Let me tell you something. Would you even have to worry about the $1,400 a month? No. Why? Because it's all going inside of the line of credit. That's why. And so now our cash flow has already jumped up $2,000. Look at this. Boom. Bing. Just like that. Okay, now we put the $5,000 inside of our line of credit. We have the $12,000 balance here. So let's draw that $12,000 balance right here. Let's draw the $15,000 limit there, okay? And let's see how this works. Let's see how we're going to pay down our line of credit. When we put the $5,000 inside of our line of credit, that's what our line of credit does. It goes down by $5,000. So now we have a $7,000 balance. But remember, we still have $3,000 in expenses. So it goes up. But the next month, it goes down. Why? Because we're putting that $5,000 inside of our line of credit each month. Absolutely. And so it goes up, it goes down, up, down, up, down. And 6 months later, you have actually paid down your debt significantly. You've paid off $12,000 in just 6 months, where if you were doing it the bank's way, it would have taken 4 long years. I know what you're saying. You're saying, well, wait a minute. Don't you still have bills? You sure do. That's what those $3,000 worth of expenses were. Those were your bills going out, all right? And you can pay them by line of credit. That's why line of credit is so awesome. Now, I have plenty more to show you, but we would just want to break this down into 15-minute segments so you're not blown away. Okay, so I'll see you in the next class. This is lesson 1. We've got, such a long way to go, but I'm so glad that you're with us. And I just am looking forward to the next class and being in the next class with you. You take care.
This is for you. This goes out to one of the best property managers. Ain't no one else out there that can hang with you. You got these apartments on lock. Your hustle don't quit and your game don't stop. I know you're sick of me not paying the rent. Got my check next thing you know my money spent. But I know I got a reckon, and I'll have your money on the 22nd.